Welcome to the Retzel Health Law Hotspot. Health Law Hotspot is a podcast for physicians and health professionals that covers the legal issues and trends that affect the healthcare industry.
Hi, everyone. Welcome to the Health Law Hotspot. I'm Erica Adler, leader of the healthcare practice and shareholder at Retzel and Andrus. And today we're having Laura Goodman join us. Laura is a partner at FGMK in their healthcare practice, and we work together a lot with various types of healthcare practices in setting up a variety of different arrangements. But today, what we're going to focus on are some of those MSO and DSO arrangements that are out there. We've been doing a ton of these, and we've done a lot of them together, and we see a lot of the same issues and questions coming up again and again. So today we're going to talk about how your legal team and your financial team should be working together to make sure that your arrangement is set up properly, some of the questions you should be asking, and some of the missteps that we've seen happen that we want to help you avoid. So thanks for joining me, Laura.
Thanks for having me, Erica.
Let's start by kind of talking about what the first step is in bringing on the financial team when somebody's decided that they're setting up a DSO or an MSO. I know that I like to do it right away. It is not my job to tell someone what fair market value is. And this is very important to make sure that that management fee between the MSO and the DSO and the actual clinical entity is fair market value, and how to structure it in accordance with state and federal laws, but also taking into account that it's got to be structured in a way that can be maintained and that will meet compliance for tax purposes as well. So why don't we start with when somebody contacts you and says, hey, this is what we're planning to do. What are some of the first steps that you advise them to take?
Well, the first consideration we look at is what is the legal structure of the various entities. A lot of people love using buzzwords. They hear LLC, they hear S Corp, they don't know necessarily what any of it means. And we work with these clients to figure out what is the best legal structure, both for the clinical entity and for the management organization. And sometimes they're two completely different entity types that may make sense. We look both from a tax standpoint, an overall economic standpoint, and then of course work with you or whoever their attorney may be, if not you, in terms of what makes the most sense from a compliance standpoint.
Okay.
Then the next focus is always the management fee. Actually, I'll take a step back. First, it's what should be running through each of these two entities. And sometimes it's more than two. Sometimes you have numerous clinical entities. But what expenses should be running through the clinical entity, and what expenses should the MSO handle that are considered, that would be covered under that management fee? And then we look at the management fee structure itself.
Okay, so in a typical arrangement, running through the clinical entity are going to be the professional amounts that are owed to doctors, dentists, other people working there.
Correct.
Anybody with a license, so to speak. I also usually like there are certain drugs that might need to be purchased at the clinical level. We often like to make sure malpractice insurance, even if the manager is taking care of making the payment, it's still a clinical expense. What
exactly
do you consider clinical expenses as well?
Generally, if there's specific clinical equipment, I would usually house that under the clinic entity, especially if it's something where the services may be designated health services and there may be billing concerns. Specific clinical drugs, vaccines, drugs, etc. Sometimes some of the clinical supplies, just because it might be easy. And then the clinical salary. I think you pretty much covered it. Occasionally, dues and licenses for those clinical providers may keep under the clinical entity. But almost everything else, general, well, let's step back, employee benefits for those clinical providers, all the labor expenses. So workman's comp, health insurance, all of those things for the clinical employees would be under the clinic. Everything else would be under the MSO, the administrative people, the people who are actually doing the billing, the software licensing, the general dues of the company, the marketing expenses, the office supplies,
Real
most of the clinical supplies, the
estate.
real estate leases. I've seen both ways. But that's more of a preference. And again, depending on the ownership, if you have multiple owners in one side and not in the other, you may want to do it one or the other.
Right. And I was going to say that sometimes it also depends on when you decided to become an MSO. So a lot of times you might already be operating and then you're like, oh, we should set up, an MSO or DSO. You might already have a lease in place and you might say, you know what, when we renew it, we'll move it. Or when we get a new lease or buy a new piece of equipment, we'll do it through the MSO or DSO. So sometimes it's also circumstance that dictates where things are going to be. Right.
And on the same line, you also may have issues with transferring if you have an existing entity. With transferring to the other entity may create a tax impact that's negative, which may lead you to just leave it where it is.
All right, perfect. So once we figure out what expenses belong where, what would be the next step?
So the next step is trying to figure out a management fee. Now, the key to these entities generally is that you want to make the clinic entity usually bare bones. You don't want to leave a lot of profit there. The profit should be flowing up to the management company. Practically speaking, though, you can't really say that. It has to be market value. It has to be something that would stand up in a third-party arm's length transaction for both the IRS to approve it and for compliance side for it to be an approved structure. So we often work with the practices to figure out what is a fair market rate for the management fee that also is large enough that it can wipe out the profit and serve the ultimate goal underlying it. And often we do that by figuring out, if it's a new entity completely, figuring out an annual budget, marking it up a little for a management fee, and saying that's a set fee. We can also do it where it fluctuates based on actual expenses, the cost plus that you and I were talking about previously. Whatever the operating expenses are, we've figured out in advance what a predetermined markup percentage will be on that. The key to this is making sure you're actually following the management agreement and you're paying that management fee, whether it's monthly, quarterly, annually, whatever your agreement says. But if you follow the terms of the agreement, it will most likely hold up under scrutiny, especially with the IRS, than if you just put it on paper and ignore it.
Right. And just for those people listening, there are, in terms of the laws that apply to management fees, depending on the state you're in, your answer might be different. So, for example, in Illinois, we can't just charge a management fee that's a percentage of collections, except as it relates to like billing and collection services. But in other states, that's not the case, right? So depending on where you're sitting, the answer to how we set up the fee might be different. If you're sitting in a state that has fee splitting, we often have to back into it in these very kind of creative ways. So, your answer could be different in different states. So for some of our ventures that are, over state lines, we might have a very set management agreement form, but the management fee might be different depending on where the clinical entity is sitting in a different state, which is something also that needs to be tracked very carefully.
Well, the other component of that is there's times also where we will bifurcate that fee or the reimbursement into different pieces. Sometimes we'll directly allocate the payroll and treat it as what's called a common paymaster. So the management company processes all the payroll and the clinic entity reimburses under that common paymaster rule for the payroll directly and the labor costs. So the management fee that's calculated with a cost plus or an estimated amount is only on some of the other expenses. So there are multiple ways to get to the same answer. And of course, state compliance is a really big part of it as well, as you mentioned.
Right. And I guess one of the concerns we always have is if the management fee is not set up properly, what are the consequences of that? And, from my perspective, we don't want somebody coming in and saying, for example, if it's a medical practice that does business with Medicare and things aren't fair market value, you could literally be, in violation of a federal law. So we need to know that it's fair market value, which is not a magic number. It's a range, but we want to be able to support through documentation, how we came up with that. So that's one reason why it's so safer to talk to someone like you than to just kind of come up with it on our own. And I know a lot of small businesses will, not want to pay someone to do that for them, and they'll come up with it. I still urge them to, be very careful about how they're doing it and to document it properly. The second issue that I see come up is that they didn't calculate it properly, and there is profit left sitting in that clinical entity. And from a legal perspective, the concern is that often when these are set up, you're using a friendly physician, for example, who's just owning it for the sake of owning it, and they're not really supposed to be making money. But when we have profit left, what do we do with it when it's sitting in that entity? Who pays the taxes on it? Who gets to keep it? So it's really important that annually we're kind of looking at the numbers, making sure everything's still fair market value. What I see being done in some of the larger ventures is they'll say, hey, we're going to set this management fee on the higher end of fair market value. And, if you can't afford it, we'll roll over that deficit and we'll take care of it eventually, right? Or we'll loan you the money so you can pay us what you owe us. And then that becomes a debt that's owed. What are your thoughts on that approach?
That's typically what I see in the larger cases, where the management fee is set in actuality higher than it's ever really going to get. And we record and document loans on the books to cover the cash flow so that it can move back and forth. Smaller entities, I've seen them leave the profit in the clinic entity 1 year, and then as soon as their attorney advises that they can restructure the management agreement, they do a new calculation and up it to try and wipe it out. Now, if the clinic entity is a C corporation, then it really doesn't impact the friendly doctor who owns the C corp, because the entity itself pays the tax, not them personally. If that entity is an S corporation or a Schedule C, a sole proprietorship, then they are paying tax on that amount. It's something that is why it's really important to work with professionals to make sure that these are structured appropriately and structured generously enough that they still meet the definition of fair value, but you're not going to run into that risk of having phantom tax to a friendly cooperative physician that doesn't necessarily have skin in the game.
Right. And of course, the other part of that is just making sure that if you're the friendly physician or you're working, for the friendly physician, that you've provided for that doctor to be indemnified so they're not responsible to pay those taxes if there's been like a miscalculation of what might be owed. And that's something we look out for when we're doing those documents as well. So what mistakes do you see people making either in setting these up or in executing? You and I do our job. We help them come up with the formula, and then they go off and they handle things on their own. Sometimes we hear from them again, sometimes we don't. Are there things that you're hearing that didn't work out well?
Well, there's two main ones. The first is those that tried to set it up themselves without you or me involved. And those are the ones that try and do a percentage of revenue. And then you end up, you're in Illinois, it's fee splitting, it's illegal. You have a lot of problems, you have to backtrack. The biggest problem I see when it's set up properly is they're not implementing it properly. They're not paying the money every month. They're not running the calculation every month like the agreement calls for. I have an audit going on right now with the IRS and a client where the IRS wants to disallow all of the deductions for management fee expense on the clinics, but not let them change the management fee income on the S Corp that's the MSO, because they never transferred money. Their bookkeeper, their internal person who also prepared their tax returns, just recorded a journal entry at the end of every year for what the management fee should be. And it's being audited. The IRS has come in and they want to disallow, and we're talking $1.5 million that they want to disallow a deduction without disallowing the income on the other side. So very, very significant dollars involved, all because they didn't follow the agreement. So having the agreement, structuring it properly is very important. But if you don't follow it and follow through, it's just as devastating as not having it in the first place.
Okay. So I think a lot of people, when they're kind of managing both sides of it, they assume they're going to just track it and it'll be okay. But what you're saying is they literally need to make the payments, even
Yeah.
if it's silly, like they're writing a check from one hand to the other, but
And they're writing a check to reimburse it to give them money to pay it. So
right,
they're loaning money in to the entity for the entity to pay them back their management fee. But the more of an actual cash trail you have in bank statements, the easier it is to have an IRS agent understand it. The IRS does not understand healthcare compliance. They don't understand why this structure is even set up and that it's really a compliance issue, and they don't care. They're looking for, is the money flowing the way the agreements say it should be? And if it's not, they can disallow it.
right. That makes sense. And I'm sure there's a lot of clients who, are doing it exactly, just handling it internally instead of documenting. So we may see an increase in the number of those kind of audits that are happening. I guess, one of the other issues that I see, and I know you and I have talked about this before, is people making things too complicated, right? So I think it's important to understand that a single clinical entity can have multiple offices. Depending on ownership, they can have multiple offices over state lines as well. You do not need a new entity for each new office. Within a state or outside a state, and you don't need a new MSO to manage each clinic. In fact, you could have a single MSO managing clinics in the whole country if you wanted to. You can handle these things through appropriate divisionalized organization.
Exactly.
Documentation, both on the accounting and legal side, can handle this. And I think the more entities that are set up, sometimes the more complicated it gets. In addition to forming new entities, we may have multiple tax returns that we have to track, multiple formation, organizational documents, etc. I always try and keep things as simple as I can. What are you seeing in terms of, how complicated some of these arrangements are getting and the reasoning behind it?
I've seen a lot of these come my way where there are numerous entities, and it's often multiple tax returns. It's annual registrations with Secretary of State of whatever state they're in. Now, under the new government rules for the Corporate Transparency Act and the beneficial ownership interest, if they qualify for that, it's separate BOI filings for each entity.
Right.
And it's the administration of making sure you're tracking the intercompany activity between each one and rolling it through the books properly, again, with proper cash flow, can be very, very, very expensive from a professional fee standpoint. And internally, having the right staff to deal with it. I much prefer that where it makes sense, use divisions. Most accounting softwares, even the least expensive QuickBooks up to the more expensive softwares, can handle multiple classes or divisions or some kind of categorization to break down between clinics.
Right.
It generally makes your payroll easier to process. I agree with you. I would prefer simple over complex unless there's a legal reason to do it. Sometimes you want different ownership or different allocations between. You can accomplish that through a compensation formula. You can pay bonuses to someone for the profit out of their division and not take into account the other divisions. So there's ways to skin the cat that you can get in the same answer with less actual legal entities.
Right.
I have seen many cases where people would prefer to have a different entity for every state. It makes the state compliance a little bit easier rather than doing a multi-state tax return. You're only filing in the state that you're operating in. But sometimes that's even making things more complex than they need to be.
Right. And I guess one other thing, just from a compliance standpoint, is if this is a medical entity, they're taking Medicare dollars in particular, and if they have any designated health services, having multiple entities can impact your regulatory compliance, referrals between those entities, allocation of revenue related to designated health services. You may or may not be START compliant. So just, for whatever reason you're choosing to do it that way, you've also got to understand if there's any regulatory restrictions or consequences for doing it that way. You may not be a group practice, under Stark, if you have multiple entities, you may not be able to share income. So there's a lot of review needed if you're a healthcare practice that takes Medicare dollars and has DHS in particular, if you're using multiple entities under this model. So hopefully somebody listening will be like, oh no, what have I done? I better go talk to someone about that. That's one of my biggest concerns because, taxes are one thing, but, violating Stark is quite another. So
Well,
big issue
exactly. Significant.
Yeah, exactly. We don't want anybody having to deal with the government, right? So I think, there are so many issues. We could probably talk about this forever. Are there any other main items you want to point out about some of the financial concerns or issues when setting these up?
No, I think my biggest warning, if that's the right word, is just make sure you're following your agreements. Make sure money is changing hands where it needs to be, and work with your professionals to make sure you haven't overly complicated your structure so that following that rule of making the money transfer is a little bit easier on you. But if you set it up right and you follow what you set up, you should be in good shape. It should be scalable, but again, most of these structures, you can add divisions under it without a problem. Again, based on ownership, you can tweak a compensation formula. But the minute you start adding more entities, you're exponentially adding to your compliance work, which adds to your fees.
I absolutely agree. All right. Well, thanks, Laura, for all your sage advice. And thank you all for joining us. I'm going to share Laura's information when we post this. So if anybody has any follow-up questions, feel free to reach out to me or to Laura. And this has been the Health Law Hotspot. You can catch our other podcasts at ralaw.com. And we'll see you next time. Thanks for joining us.
The Retzel Health Law Hotspot is made available by the firm and its attorneys for educational purposes and to provide general information, not to provide specific legal advice. Use of the Retzel Health Law Hotspot does not create an attorney-client relationship between you and the firm or any of its attorneys. The Retzel Health Law Hotspot should not be used as a substitute for competent legal advice, and you should contact an attorney in your state about any legal needs or questions you may have.